the question number 2. So the question is, 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in Paper Limited, another public limited entity, on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 1,331 million deferred until 1st of April 2026. This is what we refer to as the deferred consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. 𝐿𝐿 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐿𝐿 Limited, together with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of 𝐶𝐶𝑠 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for 3 companies, 𝐿𝐿, Paper, and 𝐶𝐶𝑠. We have the statement of financial position for the 3 companies, that is 𝐿𝐿, Paper, and 𝐶𝐶𝑠. And then we have some additional information. This was actually one of the simplest questions which has been tested in advanced level for group account. So we're given additional information. You can see limited. 𝐶𝐶𝑠 Limited on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax and other comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have on 1st of April 2024 and a further consideration of 13.1 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration. And then you're told 𝐿𝐿 Limited has a cost of capital of 10%. In the other paragraph, you're told on 1st of October 2024, 𝐿𝐿 Limited together with another entity entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of 𝐶𝐶𝑠 for an immediate cash payment of 1,500 million. The following financial statement relate to the relates to group of companies, or yes, to group of companies. So you have the statement of profit or loss for the year which ended 31st of March 2025 for 3 companies, 𝐿𝐿, Paper, and 𝐶𝐶𝑠. Then down there we have the statement of financial position for 𝐿𝐿, Paper, and 𝐶𝐶𝑠. And then down there we have additional information number 1 all the way to note number 5. What are we required to do here? We're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025. And part B, we are required to prepare the statement of financial position as at the same date. Now, remember what we said is that once you come across such a question for group account, the first thing you need to do always is you come up with a group structure. Once you come up with a group structure, then you need to go through the additional information. You see, are there some consolidation adjustments which are necessary? Are there maybe some workings you need to do? Yes. So the first thing we need to do here is basically to come up with a group structure. Let's have the group structure, or we come up with a group structure here. So where do we get the information about the group structure? This we get it from, I think, the first 3 paragraphs which are given. Let's go back to paragraph 1 of our question. In paragraph 1, you're told 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in Paper, another public entity, on 1st of April 2024. So we are told this company, which is called 𝐿𝐿 Limited, this company basically acquired 80% equity shareholding in the company which is called Paper Limited, on which date? On 1st of April 2024. Automatically, this one will be the parent, whereas this is the subsidiary. That is the subsidiary. That is the first information which you're given. And then if you check on the information we have in paragraph 2, I think you're given something to do with the purchase consideration. I think first of all, you can skip that. And then we go to note to the paragraph 3. In paragraph 3, what are we told? We are told on 1st of October 2024, 𝐿𝐿 Limited, this one, together with another entity, entered into a joint arrangement to jointly control 𝐶𝐶𝑠, a public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of 𝐶𝐶𝑠 Limited for an immediate cash consideration of 1,500 million. So this company here basically entered into a joint arrangement. A joint arrangement basically is where 2 companies have agreed they acquire equal shareholding in another entity, which is basically called a joint venture. So therefore, this company here, that is 𝐿𝐿 Limited, acquired 50% shareholding in the company which is called 𝐶𝐶𝑠 Limited, on which date? As per paragraph 3, on 1st of October 2024. What does that mean? It basically means that this company, 𝐶𝐶𝑠, this one is basically a joint venture. This one is a joint what? Is a joint venture. Is a joint what? Venture. So that basically is a group structure. And even before you proceed to do anything else, it is also always important for you to determine when the current year started and when it ended. Because now here we need to determine were these companies acquired during the current year or not. So let's go to the requirement. Let's go to the requirement. to the requirement. In our requirement, we are required to prepare the group accounts on which date? We are required to prepare the group accounts on 31st of March 2025. Now, this date we are required to prepare the group account. We refer to that date as the DOC, date of consolidation, date of consolidation. Now, automatically, the next year here will start on 1st of April. So meaning that this year started on 1st of April, 2024. That is when the year started. Now, we need to determine whether these companies were acquired during the current year by 𝐼𝐍 Limited, or were they acquired before the start of the current year. Paper Limited, which is our subsidiary, when was it acquired? 1st of April 2024. Now, 1st of April 2024 is exactly the start of the year there. So that is the date when our subsidiary was acquired. That is very important because when it comes to preparing the consolidated statement of profit or loss, take into account 𝐼𝐍 Limited was acquired exactly at the start of the year. So here we will add the revenue of the parent and that of the subsidiary, and the expenses, those of the parents, those of the subsidiary. So when taking the revenue and expenses of the subsidiary, we will take for the whole year. We are not going to apportion that on time basis. Are we together? Yes. But if, for example, this subsidiary was acquired like 6 months to the end of the year, remember, we say that when taking into account its revenue, apportion that on time basis, and also we apportion the expenses on time what? Basis. That's why it is important to determine, was the subsidiary acquired in course of the year, was it acquired before, or was it acquired at the start? So it was acquired at the start, and therefore we are going to consolidate the result of that subsidiary for the whole year. What about this joint venture? Joint venture, you can see it, the date it was acquired. It was acquired during the current year on 1st of October 2024. This is how many months to the end of the year? So in 2024, we have October, and then we have November, December, and then in 2025, we have January, February, March. Basically, these are how many months? 1, 2, 3, 4, 5, 6. So meaning that this particular company here, that is Caesar, this one was acquired 6 months to the end of the year. And also taking into account is a joint venture, you have to recall what we said in our previous session. We said whenever the parent company has invested either in an associate or basically in a joint venture, are we supposed to consolidate that joint venture or that associate? We said no. So instead, what we consider specifically in preparing the consolidated statement of profit or loss is the parent company share of joint venture profit after tax. So we will take the profit after tax for this company, basically, which is in the income statement, and because that one is for the whole year. First of all, we get the profit for 6 months because the parent company will only be entitled to share profit for 6 months, and then we get the parent company share of that, which will be equivalent to 60%. Equally, when preparing the consolidated statement of financial position, are we going to consolidate? Are we going to add together similar items of assets and liabilities, those of 𝐍 and those of Caesar? No. So we will only add similar items of assets and liabilities, those of the parent and those of the subsidiary. In relation to this company, we're going to compute something called the investment in joint venture, which we recognize as part of the non-current asset. I think we already have the group structure now there. So having the group structure, I think we can still go back to the information we have in paragraph 2. Before we go to the additional information, let's go back to paragraph 2 of that question, because we are given something to do with the purchase considerations here. And I think we have the deferred consideration. In paragraph 2, we are told the acquisition consideration, and basically that is the acquisition consideration in relation to the subsidiary. In relation to subsidiary, because that is continuation of the information we have in paragraph 1, the acquisition consideration consisted of an immediate cash payment of 2,400 million, which was made on 1st of April 2024. This one has no special treatment, and always, anytime the parent company has acquired a subsidiary and basically has paid that in cash, so this company will have accounted for that as part of the non-current asset. If you go to the balance sheet, to the statement of financial position of 𝐍, specifically under the non-current asset, can we go there? Statement of financial position of 𝐍, specifically under the non-current asset, you should be able to see that a cash consideration of 24. That is the amount invested in paper. The amount of how much? 24. I hope you can see that amount. Recognized as a non-current asset in the statement of financial position of 𝐿𝐿𝐿. Then, still in note number paragraph 2, we are told there was and a further cash payment. I hope you can see that. And a further cash payment of 1331 million deferred until 1st of April 2026. Now, this is a deferred consideration. Remember what we said in our previous session. We said any deferred consideration has to be discounted to its present value using the parent company cost of capital. And actually what you're told is that no accounting entries have been made in respect of the deferred consideration. And then you're told 𝐿𝐿𝐿 Limited, that is parent company 𝐒𝐒𝐋, that is cost of capital, 10%. Now, what we need to do in relation to that deferred consideration, we need to discount it to its present value using the parent cost of using the parent company cost of capital. So the deferred consideration, I hope you can see, this one will be paid. It has deferred until which date? It has deferred until 1st of April 2026. How many years do we have between those two dates? Between the date the parent company acquired the subsidiary, that is 1st of April 2024, and the 1st of April 2026. Do we have 2 years here? Yes, we have 2 years. 2 years there. So what we need to do here is basically we need to discount this to its present value. So we will take the deferred consideration, which is basically 1331 million. 1331 million, and then we multiply that with the present value interest factor at the rate of 10%, and basically for 2 years. For 2 years. So basically, we must remember the formula for this. So we'll take 1331, we multiply it with this present value interest factor. How do we compute this? We take 1 plus R, which will be 1.1, 1 plus R, and then we raise that for a negative n. Our n here is 2. Is what? Is 2. That is basically how we discount that. We discount that. So what do we have here? 1.1 raised to power negative 2 times 1331. And basically that will give us what? That will give us 1100. Are you getting 1100? Are you getting 1100? Are you getting 1100? Yes. Now, this 1100, remember, is a consideration to be paid after 2 years. Now, what we need to do, number one, this is an uncurrent liability. This is like a loan to the parent company. Is an amount to be paid in future. Being a loan, we have to amortize it. Now, in the process of amortizing this, we need to determine 2 things. Number one, we need to determine the interest. Anytime you're amortizing a liability, there is an interest. That interest will be recognized as part of the finance cost in the consolidated statement of profit or loss. And number 2, we also need to determine what will be the value of the deferred consideration at the end, because this is the deferred consideration at the start. Remember, the amount which we recognize in the statement of financial position as a liability should be the deferred consideration at the end, not at the start. So that's why we need to amortize this. So we need to amortize this. But basically, we will prepare this amortization schedule just for 1 year. Just for one year. Just for 1 year. Just for 1 year. So here we just need to have a column here for the year. For the year, actually, we are only preparing this for the first year, which ended 31st of March 2025. So we have the deferred consideration at the start. The deferred consideration at the start balance brought down. The next item we compute here should be the interest. Basically, we compute this using 𝐒𝐋, the cost of capital 10%. We have the other column here for the cash to be paid. And then finally, deferred consideration at the end. So you can see not much difference with how we prepare the loan amortization schedule. So the deferred consideration at the start of the year is what we have computed here, this one. So we compute interest, which is 10% of this. And that will give us 110. Is there any cash which was paid in year 1? No, because we know the cash which will be paid at the end of year 2 here. And the cash to be paid at the end of year 2 will be that one. So no cash which was paid in year one. No cash which was paid. Sasa, yes. So how do we get then the deferred consideration at the end? We take the deferred consideration at the start. This is just like a loan. We add interest minus the cash which was paid. We get this one. So, and take into account the cash consideration, the cash paid is basically 0. So we will have 1100 plus 110. And basically that will give us what? That will give us 1210. Now this one, in our consolidated statement of financial position, is an non-current liability. This is a non-current liability in our consolidated balance sheet. This one is part of the finance cost. Is part of the finance what? Cost in the consolidated income what? Statement. That's basically how we deal with a deferred consideration. With a deferred what? Consideration. And I think in our case we are done. Let's move to now additional information, because I think we are done with additional paragraph 1, paragraph 2, paragraph 3. Let's go to additional information. Number 1, we see what you're told. Let's go to number 1, and we are told that as at the date of acquisition, the fair value of Paper Limited net asset, Paper Limited is a subsidiary. The fair value of Paper Limited net asset approximated their carrying value, with an exception of some office equipment, whose carrying amount was 560 million below its fair value. At this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is administrative cost. No fair value adjustment were necessary in respect of the acquisition of Caesars. Now, this is basically the revaluation of assets by this company. Remember, this is something we discussed in our previous session, that anytime the subsidiary company is being acquired, it revalues the asset. But does the subsidiary company account for that revaluation? No. So as a result of that, in preparation of group accounts, we make 2 adjustments: the adjustment for revaluation gain and the adjustment for depreciation other charge. So we need to compute 2 values here as far as that point 1 is concerned. And remember, we refer to that as a fair value adjustment, a fair value adjustment, or basically the fair value exercise. So this is basically the revaluation of assets by who? By the subsidiary company. So the first thing we need to do here is to determine how much is the revaluation gain. Now, in that point, we are told that the carrying amount, that is in sentence number 2, is it sentence 2 or basically sentence 1? Yes, I think sentence 2. Or basically, let's go through the entire statement. We are told at the date of acquisition, the fair value of Paper Limited net assets approximated their carrying amount, with an exception of some office equipment, whose carrying amount was was 560 million below. So carrying amount was below. Below means less, or less than what? The fair value, with an amount of 560 million. 560 what? Million. Now, for us to be able to determine whether this is a gain or a loss, we have to start with the word fair value. We start with the fair word value. So if we start with the fair value, we must change this inequality sign to greater than carrying amount, with an amount of 560. It basically means that this item of equipment which was revalued, its fair value was more than carrying amount, with an amount of how much? 560. And therefore, we said if that is the case, the fair value is more than the carrying amount of the net book value. This one is what? This one is a revaluation gain. This one is a revaluation gain. Sasa. Now, this revaluation gain, it is obvious that it was not accounted for. And therefore, number 1, this one will be added to the group PP. In preparing the consolidated balance sheet, consolidated statement of financial position, we add it to the group PP. And number 2, this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we are going to use that in the computation of goodwill. So remember, I said when computing the goodwill on acquisition of this, we have to compute its net asset at the date of acquisition. How do we compute that? We said we take the ordinary share capital of this plus pre-acquisition reserves. So this one will be one of the pre-acquisition reserves. Now, next, what we need to do in relation to this revaluation, we need to compute something called the depreciation and a charge. We need to compute the depreciation what? And a charge. And I hope you can be able to recall the formula which I gave you in our previous class of computing the depreciation and a charge. I said we take the revaluation gain, we divide that with the remaining useful life or the remaining economic life of the asset, and then we multiply that with what? With the proportion of time. Proportion of time is basically the number of years or maybe the number of months we have between these two dates, date of acquisition and date of consolidation. Date of acquisition and the date of consolidation. And basically in our case, we know that this particular subsidiary was acquired exactly at the start of the year. So the date of acquisition is at the start, date of consolidation is at the end. So here we have exactly 1 year. We have exactly 1 year. In other terms, what that means is that we are going to compute depreciation at a charge just for 1 year, just for 1 year. So therefore, we take the revaluation gain, which basically we have up here, 560. We divide that with the remaining economic life of that asset. The remaining economic life of that asset, we are told, are 8 years. That is something we have in note 1, 8 years. And then we multiply that with the proportion of time, which is basically 1 year, which is 1 what? 1 year. And then we get depreciation at a charge. And remember, this depreciation at a charge is purely by paper. This one is by paper limited. This one is by paper. So this one will give us what? 70 million. Now, this depreciation at a charge, or which items will be adjusted with this depreciation at a charge? Number one, this one, if you check, there is something we are told in that point number 1, and we are saying that 1 year is basically the difference, the time between these two dates. Date of acquisition, date of consolidation. Date of consolidation is 31st of March 2025 in our requirement. Date of acquisition is the date Lock Limited acquired paper. This date here. So 1st April 2024, this is the date of acquisition. 31st March 2025, date of consolidation. Hapa tuko na mwaka mmoja. Sasa, yes, remember tulisema kama tungekuwa na miezi 6 hapa, our proportion of time there would be 6 all over 12. Are we together? Yes, but sasa tuko na mwaka mmoja peke yake. Now there is something we are told in note number 1. We are told this depreciation on equipment will be is part of the administrative expenses. So therefore, in preparing the consolidated income statement, this one we added to the administrative expenses. We added to the administrative expenses because this is a depreciation at a charge. Number 2, this one we also deducted from the group PP. In preparing consolidated balance sheet, we less that from the group PP. Number 3, this one will also be deducted from the retained earnings of this company. When computing the group retained earnings, we are going to less that. We will less that amount from the retained earnings, from the retained earnings of paper. From the retained earnings of who? Of paper. From the retained earnings of paper. And I think we are done with that particular point number. We are done with that particular point number 1. Let's move to, and I need you need to understand that particular point because this something will come across in almost all questions for group account. You'll be told the subsidiary company valued the asset but never accounted for that. So how do we deal with that revaluation of asset by who? By the subsidiary. So therefore, that is a consolidation adjustment you need to understand. We will come across that in almost all questions. So let's move to the other point, basically, which is point number 2, and we are told Lock Limited measures the non-controlling interest. Lock Limited is the parent, measures the non-controlling interest in the subsidiaries at the fair value. In other terms, it is the policy of the group to measure NCI at fair value. That basically we said will come across that statement in most of the questions. It basically means that when computing the goodwill on acquisition of this subsidiary, we are going to use the full goodwill method. We are going to use the full goodwill method because in other terms, we are told it is the policy of the group to measure LCA in the subsidiaries at the fair value. And then in the last sentence, we are told the fair value of the non-controlling interest in paper at the date of acquisition was 860. We are going to use that in computation of goodwill. And actually, goodwill will be our last working. So we move to point number 3. We are told during the year which ended 31st of March 2025, Paper Limited, which is our subsidiary, sold goods to Lock, which is basically the parent, for 500 million at a markup of what? Of 25% on cost. So basically, this is now what we call as intra-group trading. Intra-group trading. So the intra-group trading or intra-group sales, basically that one amount to 500 million. 500 million. So this one we said should be deducted from the group revenue. Once we add the revenue of this and this, we left 500. And also this one should be deducted from the group cost of sales. Once we add the cost of sales of this and this, we still left what? 500. We still left what? 500. Yes, the amount of intra-group trading. Then, in the same point, we are told half of these goods were still held by Rock Limited on 31st of March 2025, and the balances payable were still outstanding. Now, in that last statement, that last sentence, we have two adjustments. The first adjustment is the unrealized profit because some of the goods were not yet sold, and also we have amount of intercompany debt. I think, first of all, we can deal with the amount of unrealized profit. Unrealized what? Profit on inventory. Unrealized profit on what? On inventory. Remember, we say that if, for example, we have sales between the parent and the subsidiary, because we are told they sold the goods to the parent, and this company will not have sold all the goods to that parties, then the profit on those goods not yet sold is basically unrealized. How do we compute the unrealized profit? We said we take the unsold goods, the goods not yet sold at the end of the year, unsold goods, we multiply that with the gross profit margin. The gross profit what? Margin. So in our case, we are told half of the goods were still held by Rock. So the goods not yet sold were half of this. Half of 500 million. These are the unsold goods. We multiply that with the gross profit margin. Are we given margins in that question? No. In the first sentence, we are given markup. We are given markup, and basically markup is given as 25%. We are given gross profit markup, which is 25%. 25% is the same with a quarter. Is the same with a quarter. So meaning, what will be our gross profit margin here? Our gross profit margin will be equal to a quarter, and then to the denominator, this one we add the numerator, which is this, and therefore our margin will be 1 all over what? 1 all over 5. So therefore our margin here will be 1 all over 5. So what will be our unrealized profit here? What will be our unrealized profit? So this I think should be 50, because this 250, yes, this one should be 50 million. Now, this unrealized profit, number one, remember you said we added to the group cost of sales. That one will be added to the group cost of sales. Number two, we less this from the group inventory. In preparing consolidated balance sheet, we less that from the group inventory. Number three, this one will also be deducted from the retained earnings of the selling company. Remember, this unrealized profit is by the selling company. This is the unrealized profit by the selling company. The selling company is paper. So this one should be deducted from the retained earnings of paper. Paper Limited had made a profit of 50 million. It was not yet realized. So less than from the retained earnings of who? Of paper. So then in the same point, the last sentence of note 3, we are told, and the balance payable or still outstanding. The balance payable or still outstanding. Basically, what that means? What that means is that this company sold some goods to this. but this company had not paid for the goods. So that is basically an amount of intercompany debt. Now, how much will be the amount of intercompany debt here? Amount of intercompany debt. How much will be the amount of intercompany debt here? Who can tell us the amount of intercompany debt? Okay, I'm told by Anne it will be 450. Why are you getting 450, Anne? 500 minus 50. Now let me ask here, how much amount was supposed to be received? Was supposed to be received by paper from Rock? How much amount was supposed to be received by paper from Rock? Yes, in this case, it was basically an amount of 500. So this is the amount now which was not yet paid. So meaning that the amount of intercompany debt here, the amount of intercompany debt basically was how much? The amount of intercompany debt here was 500. So the amount of intercompany debt here was 500 million. This one is equal, is the amount of intercompany debt which is the same. Which is the same. So the amount payable is 500. So this one will be deducted from the group receivables, and also we rest this one from the group what? Payables. Group receivables, group what? Payables. Okay, number 4. We are told impairment review performed on 31st of March 2025 revealed that both goodwill on acquisition of paper and investment in 𝐶𝐶 were unimpaired. So the goodwill on acquisition of paper and also the investment in joint venture were not impaired. Were not what? Impaired. So we don't have any impairment loss. So finally, we are told incomes and expenses of the group of the companies are deemed to accrue evenly throughout the year. So the reason why you give that information is to help you to compute the parent company share of 𝐶𝐶's profit after tax. Because take into account this company was acquired 6 months to the end of the year. To compute its profit for 6 months, you can only apportion that on time basis. And then you multiply that with the parent company shareholding in 𝐶𝐶. Now, before we proceed to prepare what is required, there is something I want us, actually 2 items I want us to compute. Number 1, I want us to start by computing the goodwill on acquisition of paper. Remember, the goodwill on acquisition of an associate, the goodwill on acquisition of a joint venture, that one is not recognized as a non-current asset in the consolidated statement of financial position. What we recognize in the consolidated statement of financial position is the goodwill on acquisition of the subsidiary. In fact, the goodwill on acquisition of joint venture, the goodwill on acquisition of an associate, you don't have to compute that because we don't recognize that as an item of asset in the consolidated statement of financial position. So, and also remember as per note number 2, this one will be computed using the full goodwill method. We are computing this using the full goodwill method. So what we need to do here is basically to have 2 columns, and our figures are in million of shillings. The computation of this, I think, should be quite simple. So now remember, we said under the full goodwill method here, we start with the purchase consideration, which was paid by the parent. The purchase consideration paid by who? The parent company. Now, the purchase consideration paid by the parent company, this one is in paragraph 2, and this comprises of, let's go back to paragraph 2 of our question. In paragraph 2, we are given the information about the purchase consideration paid by Rock in acquiring shares of paper. So the purchase consideration paid by the parent comprises of 2, or basically it is in 2 forms. We have the cash consideration, which is in paragraph 2. The acquisition consideration consisted of an immediate cash payment of 24. This cash consideration has no special treatment, and still we have a further payment of 31, which is deferred. there is a deferred consideration. A deferred what? Consideration. And actually, this deferred consideration, we have said we have to discount it to its present value. And actually, we did that here. So we have a deferred what? Consideration, which has already been discounted to its present value. Then this is the purchase consideration paid by the parent. Taking into account we're using the full goodwill method, we have now to add the purchase consideration paid by who? NCI. The purchase consideration paid by NCI, we say that that one is known as NCI fair value. Where do we have this? We have this in note 2. In note 2 of our question, purchase consideration paid by the NCI, which is basically how much? In note 2, 860. 8 what? 60. Yes. So we need to add all this so that then we proceed and basically we less the net asset, the fair value of the net asset which were acquired. 24 plus 11 plus 860. So this will give us what? This will give us 43, 60. 43 what? 60. So having that, then what do we need to do? We need to move and basically we less the fair value of net assets acquired. We need to proceed and we less the fair value of the net assets which were acquired. So this is also one of the main problem which is encountered by the student computing this. You remember what I said, in computing the subsidiary company or in computing the fair value of the subsidiary company net asset on the date of acquisition, what do you take? You take the subsidiary company ordinary share capital plus the pre-acquisition reserves. These are the reserves the subsidiary company was having on the date it was acquired. So here we take the subsidiary company ordinary share capital. So this is the subsidiary company. So you go to the balance sheet of paper, specifically at the equity. That's where you get its share capital. Let's go to the statement of financial position for paper. How much is it? How much is the ordinary share capital for paper? Share capital for paper, can you see that? Is 2,000. Can you see that? Abdinasil, can you see this? Yes, that is the share capital. Then, before you move away from that, you can see we also have share premium. Now, in this case, anytime you're given a share premium for the subsidiary, unless told otherwise, always we treat that as a pre-acquisition, unless told otherwise. There are some instances whereby you can be given, for example, that figure 200, and then in the additional information you're told, at the date of acquisition, the share premium of the subsidiary was not 200, it was 150. So unless given such information, once you're given a share premium in the statement of financial position of the subsidiary, that one is always treated as a pre-acquisition reserve because it's a reserve. Sasa is a reserve. Now, even before you move away from that, you can see we also have retained earnings. That retained earnings, is it the one which we use here? No, automatically because we know that is the retained earnings at the end. Now, we use the retained earnings, or what we use here is the retained earnings on the date of acquisition. If you can be able to recall, there is somewhere I think we were given that. Are we given that somewhere? Have we given that somewhere? I think no, but we can be able to compute that very fast. No, that one is not given, but basically we can be able to compute that very fast because whatever you given there in our statement of financial position, let's go back to the statement of financial position of paper. So the retained earnings which are given there of 18, this is the retained earnings at the end of the year. What we are interested with is the retained earnings of paper at the start of the year because paper limited was acquired here. Paper limited was acquired here. Can you be able to compute its retained earnings at the start? Yes, very simple because from the income statement of paper, can we go to the income statement of paper? In the income statement, the statement of profit or loss for paper, we have the profit for the year. Can you see the profit for the year for paper? From the statement of profit or loss? Can you see the profit for the year for paper? How much is that? Yes, that one is basically an amount of how much? Is an amount of 520. Is an amount of 520. So therefore, we basically know that in arriving at these retained earnings at the start, at the end, sorry, we take the retained earnings at the start, which we don't have. We add the profit for the year, we get this value. So we take this, we add this, we get this. How do we arrive at this? Very simple. We will take this minus this, we get that. So we will take 1800 minus this, and that will give us 12 what? 1280. So 1280 is the retained earnings at the start of the year, and we know paper was acquired there. So therefore, what we use there is the retained earnings on the date of acquisition. The retained earnings on the date of acquisition. Do we have any other reserve in the statement of financial position or paper? No. But we must also be able to recall that anytime the subsidiary company revalued the asset on the date of acquisition, any revaluation gain, we equally treat it, we recognize it here as a pre-acquisition a revaluation reserve. And I hope you can be able to recall here in working 3, paper limited revalued the asset. There was a revaluation gain of 560. We said this one is what? Is a pre-acquisition reserve. So we have 500 and what? And 60. And I think in our case, we are basically done. We don't have any other pre-acquisition reserve. What we need to do is basically we get the total. We get the total. Let's get this total. We add all those values there. We add all those values. So we have 22 plus 1280 plus 560. And that will give us what? That will give us 4040. 4040. Take into account we are using the full goodwill method. We take 100% of this. We're interested with the net asset acquired by the parent and who? The NCI. 4040, 100%. But if you were using a partial goodwill method, we would have taken 80%. So we less that from that value here. And basically that will give us goodwill of 320. Goodwill of 320. Remember, this one is an non-current asset in our consolidated statement of financial position. So we are done with that. Then the other maybe working we need to do, remember we have a joint venture here. So in preparation of the consolidated statement of financial position, do we consolidate the asset and liabilities of the joint venture with those of the parent? No. So what we do, we, in relation to this joint venture, we recognize something called investment in joint venture. And I think we looked on how we compute the same in our previous class. That is basically what I want us to compute here. The investment in what? In joint venture. Investment in joint what? Venture. And this one will be recognized as an non-current asset. How do we compute this one? You just need to remember that format which I gave you. We said we take the cost of investment. The cost of investment. So how much amount did the parent company paid in acquiring shares of 𝐶𝑠𝑎s? We have that information where? We have that information in paragraph 3. So when the parent company acquired 50% shareholding in 𝐶𝑠𝑎s, the parent company paid 1,500. Equally, that amount should be, you should be able to see that amount in the balance sheet of this, in the balance sheet of the parent under the non-current asset. Under the non-current asset, we have investment in 𝐶𝑠𝑎s. How much is that? 1,500. That is the cost of investment. The cost of investment, the cost of investment. And then to this, we said we add the group share, or in other terms, the parent company share. The parent company share of joint venture, post-acquisition, retained earnings. The parent company share of 𝐶𝑠𝑎s, that is the parent company share of 𝐶𝑠𝑎s, post-acquisition retained earnings. So basically we know that this company here, joint venture, it was acquired 6 months to the end of there. So what we need to do basically is we go to the income statement of 𝐶𝑠𝑎s, not in the balance sheet, in the income statement of 𝐶𝑠𝑎s, and we take the profit after tax for 𝐶𝑠𝑎s. So how much is the profit after tax for 𝐶𝑠𝑎s from its statement of profit or loss? It is basically 640. I hope you can see that, 640. Now, this is the profit for the whole year for CSAS. The parent company will only be entitled to share a profit for 6 months because it acquired this one 6 months to the end of the year. So the parent company will be entitled to share half of this, which is basically half of that, which is basically what? 320 million. So this is what the parent company is entitled to share. And then we compute the parent company share of that. The parent company share of this, take into account the parent company has got 50% shareholding. The parent company share of that is what? Is 50%. 50 what? Percent. So therefore, to compute this, the parent company share of joint venture post-acquisition retained earnings, we have said we take what? 640 times 6 all over 12 times what? 50%. Times 50 what? 50%. Which basically will give us what? Will give us 160. Will give us 160. And then after adding that, what do we less here? We less any impairment loss. We less any impairment loss. But if you can be able to recall what you're told in note number 4, the investment in joint venture was not impaired. So in our case here, we don't have any impairment loss. But if there was any impairment loss, you erase it from whatever you get here. And basically what we get here will be the investment in joint venture, which you're going to recognize as an non-current asset. And that will be how much? That basically will be 1660. So this one is a non-current asset in our consolidated statement of financial position. I think now what is now remaining is we do the consolidation because I think we have done much of the workings here. It's just a matter of preparing what is required. So let's move to Roman 1 of our question now. In Roman 1, that is part A, we are required to prepare the consolidated statement of a profit or loss, which is basically for the year which ended 31st of March 2025. 31st of March 2025. Now, how do we prepare this one? How do we prepare this one? Taking into account, we should be guided by our group structure. We should be guided by our group structure. So we will basically consolidate similar items of revenue and expenses, those of ROC and those of the parent. And basically for the parent, we are taking for the whole year, taking into account it was acquired exactly at the start. We are not apportioning that on time basis. Are we supposed to consolidate the revenue and expenses of this joint venture? No. So in relation to this joint venture, what we will recognize there is the parent company share of joint venture profit after tax. Profit after what? After tax. Sasa? Yes. So therefore, let's do this one. Let's prepare this. We just need to have a single column here. We just need to have a single column here. And we basically prepare this from the statement of profit or loss for individual companies. We will start with the revenue. We will start with the revenue. So remember, we are adding the revenue of the parent and that of the paper. We are not consolidating CSAS. We are not consolidating CSAS. So we take the revenue of ROC, which is basically 8520, plus that of paper, which is basically 5180. And then to this, what do we need to less? We need to less any amount of intra-group trading. Do we have any amount of intra-group trading between the parent and the subsidiary? Yes, this one here, 500. So no any other adjustments. And basically we get the final value. But I think we can do this. Can we first of all have all the values here, and then we will come back and then we have the final values. Yes, we do the workings, we get the final values here. So then we need to have the cost of sales. We do the same, 5510 plus that of paper, 3440. And then now to this cost of sales, we have a number of adjustments. One, we have this intra-group trading of 500, we less it here. We also have this and this profit of 50, which should be added to the group cost of sales. Then what else do we have? Do we have anything else? No, because this depreciation under charge, This goes to administrative expenses. No any other adjustments. We will get the gross profit. And then before we list now the expenses, before we list those expenses, remember you have a joint venture here. So in relation to this joint venture, we need to compute something called the group share. The group share, law joint venture, profit after tax. And actually in this case, we have said, we will take the profit after tax of Caesars from its income statement. There is somewhere we have used that profit, which is basically 640. And because that is the profit for the whole year, we have said that the parent company is only entitled to share that profit or is entitled to share profit for 6 months. And then we multiply that with the parent company shareholding, which is basically what? 50%. I think this one was giving us 160. So that one is recognized as an income. Then from there we proceed, we consider the expenses. Let's go back to the statement of profit or loss for individual companies. We will start with the distribution cost. And anytime you come across a question for group accounts, these always have 3 marks. Distribution cost has no adjustments. So we just take that of the parent, 830 plus 470, no adjustment. Then we have the administrative expenses. We take that of the parent, which is basically 860, plus that of paper, which is basically 520. And then in this case, recall, we have this depreciation other charge, this one, which we said should be added to the admin expenses, to the administrative expenses. We add 70. Any other adjustments? No, any other adjustments. So then from there, we will have the profit before tax. But before we do that, we must also remember this interest on deferred consideration, which we said will be recognized here as part of the finance cost. And basically it is an amount of 110. An amount of how much? 110. Yes. And then we will get the profit before tax. And then we less the income tax expense. Income tax expense always in any question for group account. This is also a 3 mark. No adjustment for this. So which is 450 plus 230. And basically that will give us a figure of 680. And then we get what? We get the profit for the year. We get the profit for what? The profit for the year. I think now we can get the final values there. We start with the revenue. Let's go back to the revenue. We have 8520 plus 5180 minus 500. Confirm whether you're getting this value here for revenue. 13200. 13200, is that what you're getting? And Mike Patrice, is that what you're getting? Yes. So what about the cost of sales? We have 5510 plus 3440 minus 500 minus 500 plus 50. And basically that will give us 85. I hope that is what you're getting. We less that from our sales, our group revenue, 13200. And basically I'm getting gross profit of 47. Gross profit of 47. Okay. So we already have the group share of our joint venture profit after tax. The administrative expenses, 830 plus 470. And that will give us 1300. Remember that one should be recorded here as a negative. What about the administrative expenses? We have 860 plus 520 plus 70. And basically that will give us what? That one will give us 1450. Yes. And then we get the profit before tax. Now, Mary, remember what you were told in note 1. So note 1, can you go back to note number 1, Mary? The last sentence, the last paragraph of note 1. Depreciation on office equipment is an administrative expense. This depreciation at the charge, remember, if the question was silent generally, that is supposed to be added to the cost of sales. But This one we are told is part of the administrative expense. That way we are adding it here, not under the cost of sales. I hope you can see that now. Yes. So we get the profit before tax. We will take gross profit 47 plus 160 minus the three expenses 1300 minus 1450 minus 110. And basically that will give us 2000 minus 680. And basically that will give us 1320. 1320, yes, that is very much correct. And basically this now what was required, this now what is marked, this. So usually you'll see that like that question, you'll be given 2 marks for every correct entry. So mean that you need to get 5 items correct there. And then yes, 5 items, and basically you get a total of 10 marks. And remember you have said that once you come across that question, this is always a 3 mark income tax and that one. Sasa, yes. So I think we are done. Let's move to part B. And basically we are required to prepare the consolidated statement of financial position as at 31st of March 2025. As at 31st of March 2025. Now, how do we prepare this one? We should be guided by our group structure. Basically, here we are combining. We should combine similar items of assets and liabilities. Those of the parents, those of the subsidiary, we don't consolidate and associate a joint venture. So what we are going to include, say, as far as 𝐶𝐶 Limited is concerned, is what we have computed down here. The investment in joint venture, which we recognize, we are going to recognize that as one of the non-current assets. Yes. So let's just have a single column here. We have a single column here. We start with the non-current assets. So for the non-current assets, we get this from the individual statement or the statement of financial position for individual companies. So we have the PPE. We take that of the parent, which is basically 4260, plus that of paper, which is 3630. We have some adjustment to be made to the group PPE. Number one, we have this revaluation gain of 560. We said that one should be added to the group PPE. We also have this depreciation other charge of 70. We said should be deducted from the group PPE. Yes. No any other adjustment. So let's first of all remove to the other item before we make those before we get to the final values. So below that we have investment. We have investment in paper, investment in 𝐶𝐶. Remember these are the purchase consideration which were paid by the parent. Do we recognize them here? No. But in relation to the purchase consideration paid in acquiring the subsidiary, so what we recognize here is the goodwill, the goodwill arising from the acquisition of what? Of paper. The goodwill arising from acquisition of paper, which you have already computed here as an amount of 320. In relation to that other amount which was paid in relation to acquisition of 𝐶𝐶, we still don't recognize it here. What we recognize here is what you have computed here. Investment in joint venture. Investment in joint venture, which is basically that amount which is up there, 16 what? 16. Yes. Anything else? No, we don't have any other than current asset. And think then below that we have current assets. And the current asset, we are given that as a total. We're given that as a total. So we will just take the current asset of the parent, that is 720, plus that of the subsidiary, which is 2270. But here we must remember what is included here. What is included within the current asset is receivables, inventory, cash and bank balance. So any adjustment affecting those items should be done there. So the first adjustment which you're going to make here is in relation to this unrealized profit, the unrealized profit of 50, which should be deducted from the inventory. Inventory is part of this. So to this, we less 50. We less 50. Then here we have amount of intercompany debt 500. which should be deducted from the receivables. Yes, we less the receivables. Anything else? No. No. So I think now we can get the final values for the assets here. So let's start with the PP, 4260 plus 3630 plus 560 minus 70. Basically, that will give us 8380. What about the current assets? That is 720 plus 2270 minus 50 minus 500. So that will give us 5440. That is basically the final value I'm getting. So let's get the total assets here. The total assets. So the total assets. The total asset I'm getting 15,800. 15,800. That is what I'm getting is the total assets. What I'm getting is the total assets. Now, let's move and record equity and liabilities. I'll do away with this because of my space. Because of my space, we are not going to touch those consolidation adjustments. Let me do away with this, including this one. I think we have dealt with that. Yes. So we start with, or basically we record equity. Equity is the share capital and reserves. And remember what we said in our previous class. Whenever you're preparing this consolidated statement of financial position, we only consolidate, we only combine similar items of assets and liabilities, not items of equity, items of assets and liabilities. The reason why we don't consolidate items of equity is because if you check on how we have computed this goodwill, we have used the items of equity of the subsidiary. That's why we don't consolidate similar items of equity. So we only consolidate similar items of asset and liability. So the items of equity, mostly which we include here, are for the parent company. For example, for the ordinary share capital, we will only include that of the parent company only. Parent company only. Parent company only, which is 5,000, simply because that of the subsidiary, you can see it was used in the computation of goodwill. Share premium, we only include that of the parent company only. That of the parent company only. And that is basically 500, simply because that of the subsidiary equally was used in the computation of goodwill. Below that, we have the retained earnings. So basically, in this question for group account, this is one of the items which is quite demanding in terms of its computation. So we will compute that in this question. But now moving forward, in the other questions we will be doing, we will not be computing that, because even in an examination setup, this is an item I will basically advise you, don't compute that. If you can compute that item and you get it correct, it basically means that all the other values here are correct. So this question, we're going to compute it, but moving forward, we will not be computing that. But let's have that as the last working. So we can first of all skip that, but we'll come back there. Then we get the total equity. Then to this, there is something else we also compute here. We compute and basically recognize it here. And that is something called the non-controlling interest. The non-controlling interest, basically, this is the amount of money which is invested by the minority shareholders in the subsidiary. So the amount invested, because whatever you have here, this is the amount invested by the parent. The investment by the parent, or the capital contributed by the parent. Remember, in this subsidiary, there is money which is invested by the minority shareholders. That one should be computed and recognized there as a separate item. I'll be able to show you how to compute the same. But equally, that will be, we are going to do that after recording the other items. Okay, so then from there, what do we have? We have the current liabilities. Current liabilities. So for current liabilities, we take those of the parent, which is basically 3,000, plus that of the subsidiary, that is 19. But now we have to remember that these include payables. There is an adjustment to be made to the payables of 500. Do we have any other adjustment? No. And I think we don't have any other liability. So this will give us what? This will give us 14. And basically, I think that will give us what? 44. That will give us what? 44. So, and then we will basically get the total equity and what? And liabilities. That will basically give us this one. But there are two items we need to compute here, the NCI and the group retained earnings. So let's start by computing the group retained earnings. I want us to start by computing the group retained earnings here. The group retained earnings. Now, how do we compute this one? Group retained earnings. So the group retained earnings to be recognized here, we take 100% of the parent company, retained earnings, 100% of the parent company retained. Oh, yes. Thank you, Raphael. I can see there is something we are forgetting here. There is this deferred consideration to remember, which we say should be recognized here. Before we compute this, let's include that deferred consideration. Thank you, Raphael, for reminding us that. Yes, now this deferred consideration, remember, it should be recognized here as an uncurrent liability. The deferred consideration, and basically that is this amount here. That is the deferred consideration at the end, which is basically 12 what? 1210. So that will give us 15,800. Sasa, yes. I think I was explaining how we compute the group retained earnings. And I'll say that this one is computed by taking 100% of the parent company retained earnings. We take 100% of the parent company retained earnings, though that one may be adjusted with some few items. And then for the subsidiary, this one, we take 80% of subsidiary post-acquisition retained earnings. We only consider the post-acquisition. Reason being, the pre-acquisition was used in the computation of goodwill here. And then for the other company that is 𝐶𝐶, we will take 50%. And I think there's something we have already computed, 50% of joint venture post-acquisition retained earnings. Remember, we have already computed this one. This is now what was coming to 160. 160. Sasa? Yes, that is what was coming to 160. Now, basically what we need to do here is we can have 3 columns here. Let's have 3 columns. So for the 3 companies, the parent company is 𝐿𝐿. The subsidiary, this one is paper. Then this one is 𝐶𝐶. Is what? Is the 𝐶𝐶 there? Yes. And I think for 𝐶𝐶 here, we will not do a lot of working because we have already computed this value. Silio. So for 𝐶𝐶, we shall compute this one. So here 𝐶𝐶, we will just have 160. Sasa? Okay, although we can do this one because kuna mari tutapra those percentages there. So this company reported its post-acquisition profit after tax was 640. I hope you can remember that, times 6 over 12. So this one was coming to 320. That's that? Yes. So what we will do here, we start with the retained earnings. Now for these 2 companies, we only consider the post-acquisition. I hope you can see here. Post-acquisition. But that does not apply to the parent. The parent, we take 100% of the retained earnings. So the retained earnings of the parent, we get it from the balance sheet of the parent under equity. Of the parent company under equity, we take the full amount, which is that 380. But now for this company here, paper, the retained earnings in the balance sheet is 18. Can you see that 18? 18. Now this 18 comprises of pre-acquisition and post-acquisition. What we should include there is post. Post. The reason being pre-acquisition was used here. You see whatever you have here, this is pre. So what we should include here is the post. Although we can do this, okay, let's just do that working separately here. So we will take 18 minus 3, which is 1280. So, and this basically will give us 5 what? 520. This is basically pre. This is not pre, post acquisition. Post what? Acquisition. For the other company here, we have said we take it post acquisition, which basically will be 640. We multiply that with 6 all over 12. We take the full amount because kuna mari to apply those percentages down here. We take 3 what? 320 like that. Then, if you check on the workings we did here, there are some items to be adjusted to these retained earnings. So let's go through the workings here. We have this deferred consideration, it will not affect that. But now we have this interest. You see this interest on the deferred consideration. This one is an expense to the parent. This one is an expense to the parent. Now, the parent company automatically had not accounted for this deferred consideration. The parent company equally had not accounted for this as what? As an expense. Or if the parent company had accounted for that 110 as an expense, that was supposed to be deducted here, but it was not deducted. So what we will do, we will deduct the interest on deferred consideration from the profit from the retained earnings of the parent. Because the company which recognizes this as a liability is the parent. It's the parent to pay the consideration in the future. So from there, anything else? Yes, we have this depreciation other charge by paper, and we said we are going to deduct that from the retained earnings of who? Of paper. So we say here we have depreciation other charge by who? By paper of 70 there. Of 70 there. Okay. So then from there, what else do we have? What else do we have? We have this one will not affect the retained earnings. We have this unrealized profit. That one will be deducted from the retained earnings of who? Paper. And realized profit from the retained earnings of paper. How much is that? 50. It should be deducted. Should be deducted. So this one does not affect. This one does not affect. I think we don't have any other adjustment. So basically, we need to get the final values. This one will be 320. This one 20, which basically 400. What about this one? 3270. 32 what? 70, 3270. Now, having that, then we need to apply these percentages because you have said for parent, we take 100%. For this one, we take 80%. For this one, we take 50%. So we basically need to apply those percentages. So this one will be 3270. And 80% of this will be 320. 50% of this will be 160. 160. And then what we need to do, we add all these values. That is basically how we get the group retained earnings. You can see the computation of this quite involving. That's why basically I'm advising. If, for example, you're doing such a question in an examination setup, I will not advise you compute that. I will not advise you compute what? You compute that. What are you getting here? What are you getting? Yes, that will basically give us 37 what? 50. 37 what? 50. That is basically what I'm getting. And I hope our computation is correct. I hope there is nothing we have omitted here. Yes. Okay. So let's get the total equity here. It will be 3750 plus 55. And that will give us 9250. 92 what? 50. Now, finally, we need to compute the NCH fair value. NCH fair value. Now, remember NCI at fair value, This is basically the amount of money invested by the parent, by the minority shareholders, the amount invested by the minority shareholders here in the subsidiary. How do we compute the NCI at fair value? And that is basically at the end of the year. So to compute this one is quite simple, because what we do, we take the NCI at fair value on the date of acquisition. On the date of acquisition, and this basically is what we have in note 2. This is what we have in note 2. And you are saying what? The interest on deferred consideration is not 1100. It is 110. This one. It is 110, not 1100. The interest is 110. Is 110, not 1100. It should be 110. So, yes. Let's come back here. We are saying, how do we compute the NCI at fair value? We take the NCI at fair value on the date of acquisition. That one is in note number 2. And this one is what? 860. Now to this we add, once you have invested in a company, basically your investment will keep on increasing as a result of the share of profit you're entitled from that company. So to this, what we do, we add the NCI share of post-acquisition adjusted retained earnings. NCI share of post-acquisition adjusted retained earnings. Now, the NCI will be entitled to, remember, minority shareholders have invested in our subsidiary. So we need to compute the share of their adjusted, that is the share of post-acquisition adjusted retained earnings. And basically that's what we have here. You see, whatever you have here, that is 400. That is now the paper limited post-acquisition adjusted retained earnings. Yes, that is paper limited post-acquisition adjusted retained earnings, which is what? 400. What is the NCI share of this? The parent company has 80% shareholding. The NCI share should be 20%. 20% of that will be 80. Will be what? Will be 80. And I think we are basically done. So we have 860 plus 80. And that will give us what? That should give us 940. 940. That is basically the NCI at fair what? At fair value. So basically add all that, you see now whether it will balance. Yes, so that is it. That is it. Is it? Are you getting up the 15,800? 15,800. Equity plus NCI plus current liabilities plus deferred tax. Yes. So basically that is it. That what's required, and basically by doing that, the marks allocated there were 10 marks. Were 10 what? Were 10 marks. So it's a very good question on group accounts. But basically what I've said is that moving forward, there are some items we will not be computing, because I've said even in an examination setup, you can't compute those 2 items. Mostly those 2 items, retained earnings, NCI, the computation of the same of that is quite complex. For example, with that question, you don't have to get everything correct. You may see, for example, this is how the question was marked. Any 5 at 2. If you get 5 items correct, you're given 2 marks for it. So basically it means that you needed to get 5 items correctly, and you get all the marks. You don't have to get everything correct for you to get the allocated 10 marks. So yes, so maybe you can do this. You can attempt the other questions which I gave you regarding the normal consolidation, because this is a concept you did in a fund. And I think once we meet now in our next class, we are going to look on this. The piecemeal what? The piecemeal, also called the piecemeal, or basically something called the stage what? The piecemeal or the stage acquisition is the same concept, but there is a small concept which you didn't cover, especially the computation of goodwill here. And then we will just have a small introduction on this, small discussion on this, and then we do a question, meaning that this should just take us one class. And then on Wednesday, we look on how we prepare the group accounts in case of disposal of interest. Saturday, I want us we do the how we basically look on how question 1B. Question 1B. Are you there, Zephyr? Sadrach, are you there? Aaron, are you there? Reese, are you there? Is Elizabeth Betty here? Reese, are you here? Emma, you are there? You are there? Okay. Natalia, are you there? Okay. So basically, what are we told here? What are we told as far as that question says concerned? What are we told? So the question reads, basically a small one. It reads, Godoro Limited supplies high quality mattresses. The company outsourced these mattresses from a supplier in town, and then you're told Godoro Limited estimate that the total inventory holding cost, the total inventory holding cost of one mattress per annum is as follows. So basically, what you're given here is the holding cost. So we are given the various components of the holding cost, which comprises of the opportunity cost, the obsolescence cost, the storage charges, the handling cost, and the insurance. And basically, you're given those particular costs as a percentage of the purchase price per unit. And basically, you can see we are given the total holding cost as 15% of the purchase price per unit. And then number one, we have some additional information. Number one, you're told the annual sales demand of the mattresses is 480 mattresses. Number two, you're told each mattress costs shillings 4,000 to purchase from the supplier. Number three, we are told the ordering cost is 62.50 per order. And then finally, you're told the suppliers offer a 3% discount for orders of 120 mattresses and a discount of 5% for orders of 180 mattresses. So what are we required to do here? In Roman 1, we are required to compute the economic order quantity of the mattresses. In Roman 2, we are required to determine the cost minimizing order size from the supplier. We are going to start with Roman 1, and then I'll be able to explain how we do Roman 2. So in Roman 1, we are required to compute the economic order quantity of the mattresses, the economic order quantity of what? Of the mattresses, economic order quantity of the mattresses. So automatically, the first thing we need to recall here is how do we compute the EOQ? To compute the EOQ, the economic order quantity, we take the square root of 2DC naught, that is 2, multiplied by the annual demand, multiplied that with the ordering cost per order, and basically divided that with the HC. HC is the holding cost or the carrying cost per what? Per unit. Now, do we have these values here? Do we have these particular values here? Yes. So if you go back to the question, I think the additional information, and remember in our case, we are told that this company basically deals or basically sells mattresses. So if you go to note number 1, in note number 1, you're told the annual sales demand of the mattresses is 480 mattresses. So basically, it means that this company here basically do what? It purchases some mattresses, and then it sells those mattresses. So we are told the annual sales demand is 480. So basically, what our company here need to purchase in order to sell will be 480 mattresses. So these are the mattresses which are purchased by our company. So that is basically the annual demand. Do we have the ordering cost per order? Yes, the ordering cost per order, basically this one is given in note number 3. Additional information number 3, we are told the ordering cost is shillings 62.50 per word per order. So that is basically the ordering cost per order. What about this one? HC, the holding or the carrying cost per mattress. So that one is basically given below paragraph 1. And you're given the holding cost of mattresses per annum, and basically you're given that is a percentage. So you can see we're given various components of these holding costs, but basically what we consider here is the total percentage. The total percentage, which is below paragraph 1, 15%. And basically, if you check up there, you'll be able to see that percentage, or this is a percentage of the purchase price. So to compute this one, we take 15% of the purchase price per mattress. So what is the cost, or what is the purchase price per mattress? Can you be able to see the purchase price per mattress? This company purchases each mattress at an amount of how much? Can you see that in the additional information? Yes, I'm told by 𝐼𝐻𝐿. In additional information number 2, each mattress costs shillings 4,000. Cost shillings what? 4,000. So therefore, that is the purchase price. So this one is always computed as a percentage of the purchase price. The purchase price is what? Is 4,000. So this will give us what? Will it give us 600? Is it 600? 600? Is that what you're getting, Emma? Aaron, are you getting that? Abdinasil, are you getting 600? Yes. So in our case, therefore, we can move and basically we compute the economic order quantity. So by taking 2 times the annual demand, which is basically for 80, times the ordering cost, which is basically 62.50, divided by holding cost, which is basically what? 600. Which is what? 600. So let's get the final answer here. We get the final answer. We get the final answer here. So what will be the final answer? So we have 2 times 480 times 62.50 divided by what? 600. And basically that is giving us 10,000. So that means that the economic order quantity here are 100 mattresses. Are 100 what? Mattresses. 100 what? Mattresses. So what does that mean? What does this mean? That the economic order quantity is 100 mattresses. It basically means that for this company to be able to minimize the costs associated with the inventory, the holding cost, the purchase cost, and also the holding cost, the company, anytime the company is placing an order, our company should order how many mattresses? 100 mattresses. That is the economic order quantity. It is the order quantity which will minimize the company's what? The company's inventory, the company's cost associated with what? With this particular mattresses here, or basically associated with the purchasing these particular mattresses. Now that basically what is required in Roman 1, and basically by doing that, the marks are located there were 2. Then I want us to move to Roman 2, and basically what are we told? We are required to compute the cost minimizing order size from the supplier. The cost minimizing order size, order what? Size from who? From the supplier. From who? From the supplier. So in other terms, what you are required to compute here is the order size, which by the end of the day will do what? Will minimize, that is the company's what? The company's cost associated with what? Associated with the inventory. Now, which order size do we have? Now, in this case, if you go back to the information which are given in note number 4, can you go to note number 4? Because that is what you're going to use here, plus what you have computed up there. We are told the supplier offers 3% discount for orders of 120 mattress. Now, remember what we have said in Roman 1. For this company to be able to minimize the cost associated with the basically ordering and also holding these particular mattresses, the company has to order how many mattresses? 100 mattresses. Through that, the company will be able to minimize the total cost associated with this particular inventory of mattresses. But the supplier here has extended a discount to this company, and the company is told that if the company orders 120 mattresses instead of 100, the company will get a 3% discount. Automatically, what that means is that, remember, the purchase price per mattress is 4,000. So if the company purchases from 120 mattresses, the company will not pay 4,000, but the company will do what? Will be given a 3% discount. The price now to be paid will be 97% of this. So then in the same point, you're told, and a discount of 5% for orders of 180 mattresses. For orders of 180 good mattresses. So therefore, in this case, our company has 3 options. Our company has 3 options. Number 1, either to order 100 mattresses, which is basically the company's computed economic order quantity, or the company to order 120 mattresses and basically qualify for 30% discount, or the company orders 180 mattresses and the company qualify for 5% what? Discount. Now, the company has those three options. Now, what we are required to do here is basically we determine the order size, either 100, 120, or basically 180, which basically will result to the least cost. To the least what? A cost. Basically, what in other terms we need to do is to evaluate those three orders. How do we evaluate the orders? Usually in management accounting, we evaluate the options in terms of the cost. In terms of what? The cost. Because the company here has three what? Option. Either to order 100, to order 120, or to order what? 180. Which cost do we need to compute here of each order size? We need to compute the total cost, which will comprise of the three costs: the purchase cost, the ordering cost, and also what? And also the holding cost. So therefore, but before we do that, we need to list those options available to this company. So we have said our company has got three what? Options: either to order 100 mattresses, or the company can order 120 mattresses, or the company can order what? The company can order 180 mattresses. 180 what? Mattresses. Now, if the company orders 100 mattresses, what will be the purchase price? The purchase price, in fact, we can just write it up there. Purchase price, which is denoted by small p, that one will be 4,000 per mattress if the company order 100. And then we also know what is the holding cost. The holding cost here will be 15% of 4,000, and basically that will be what? Will be 600. But now, if the company orders 120 mattresses, the company qualifies for a 30% discount. What will be the purchase price here? The purchase price will not be 4,000, but our company getting a 30% discount. So the purchase price here will be 97% of 4,000. So this will give us a purchase price of how much? A purchase price of how much? So the company will get a 30% discount. So instead of paying 4,000 for each mattress, the company will pay 97% of that. That will give us how much? Yes, I'm told by Jefa that this will give us 38.80. So that will be the purchase price per mattress. And then that also means that we will have a different holding cost, because holding cost, this one is always computed as a percentage of this. So the holding cost here will be equal to 15% of 38.80. 38.80. So let's compute this one. The new holding cost. The new holding cost, I'm told this one by Naitare will be 582. 582. 582. 582. 582. So we do the same for the other order size, which is basically the company ordering 180 mattresses. So here the company will get a 5% discount. 5% discount. So mean that the purchase price here will be 95% of 4,000. Or 4,000. So how much will be the purchase price? Yes. How much will be the purchase price? How much will be the purchase price? How much will be the purchase price? Yes. The purchase price here will be 38, and then the holding cost here will be 15% of this. 15% of that. So what will be 15% of that? It will be what? It will be 5 what? It will be 570. It will be 5 what? It will be 570. It will be 5 what? 70. Now, having this information, what I want us to do, I want us to evaluate these three options. And basically, I've said we evaluate these options, these three options, in terms of computing the total cost of each option. How do we compute the total cost? The total cost, this one is equal to the purchase cost. The purchase cost is equal to annual demand times the purchase price per unit, which is basically small p. This is a multiplication sign. Then to this, we add the holding cost. The holding cost. How do we compute the holding cost? The holding cost is equal to Q. And basically, in this case, when we talk about Q, remember, is the order quantity. Because, like in this case here, our Q will be 180. Here our Q will be what? 120. Here our Q will be 100. Q is basically the reorder quantity. So we multiply that with HC, and then to this we add what? The ordering cost. So the ordering cost would be equal to annual demand divided by Q times what? Times C naught. Times C what? C naught. This is basically how we compute the total cost of each option here, of each what? Option. So what I want us to do, I want us now we compute the total cost associated with each what? With each order size. Associated with each order size. So let's start with this order size, where our Q will be 100 mattresses. 100 mattresses. 100 mattresses. So we need to compute the total cost. So what you just need to note is what will be changing, but our formula is also very, very important. We start by computing the purchase cost here. So the annual demand, this one will not change in all options. So what will change is the purchase price. For example, here the purchase price is 4,000. Here is 3880. Here is 3800. The purchase price will have to change. The other item which will have to change for the different options is the holding cost, this one. But now this one, nothing here is nothing, or basically what will change here is just the Q. It's just the Q here. Yes, so we start with this one where our Q is 100. So we take the purchase price, we take the annual demand. Remember, the annual demand will not change. What this for 80 mattresses? The annual demand, yes, the annual demand in note number 1 is for 80 mattresses. We multiply that with the purchase price per unit, which is this one, which is 4,000. 4,000. So that is the purchase cost plus now the holding cost, which is equal to Q. Our Q here is 100 divided by 2. And then to this we add what? To this we add, okay, we multiply that with this one, with the holding costs per unit. And then to this we add the ordering cost. The ordering cost is equal to annual demand, which is 480. Remember that is our annual demand, divided that with the Q. Our Q is 100. We multiply that with what? The ordering cost. The ordering cost is one will not change. It remains as given in note number 3. 62 what? 6250. So we need to get the total cost. But you also need to note that this 100, this remember is our economic order quantity. And basically we say that at economic order quantity, I think I demonstrated this using a graph. I said at the economic order quantity, so basically these two costs are always the same. The holding cost and the ordering cost are the same. The holding cost and the ordering cost are the same at the economic order quantity. So these two costs, this and this should be the same. I don't know whether you're getting the same value. So this one should be the same. Are you getting the same value? 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 Yes, I'm told it's 30,000 each. At economic order quantity, those two costs are the same. Okay, so having that, we need to evaluate the other option, which is basically ordering 120 mattresses. 120 mattresses. So, and we do the same. We compute the total cost, which will be equal to the purchase cost, which is basically equal to the annual demand. This will not change, times the purchase price per unit, which is now 3880. 3880. And then plus the holding cost, which is equal to Q. Our Q here is 120. Is 120 divided by 2 times what? The holding cost. The holding cost is 582 plus the ordering cost. Ordering cost is equal to annual demand for 80 divided by Q, which is 120 times what? The ordering cost per order, which is 62 what? 6250. But now in this case, you'll be able to see 120 mattresses is not our EOQ. So therefore, these two costs will not be the same. So these costs are always the same at the EOQ. At EOQ. 120 is not our EOQ. So the two costs will not be the same. So get for me the final value here. Get for me the final value here. The final value here. The final value, what are you getting? The final value, what are you getting? What are you getting? What are you getting? $19 what? Yes, I'm also getting 19, 22, 320, 320. Yes, so that is the figure I'm getting from Emma. Are you getting the same? Are you getting the same, Aaron? Jeff, are you getting the same? Sadrach, are you getting the same? Are you getting the same values here? DP, are you getting the same value? Are you getting the same value? Please try to hurry up. I want us to do more questions on this. Yes, so that is confirmed. So let's evaluate the last option, whereby the company has been given a discount if it's order 120 mattresses. So we need to get the cost of this order size. So the cost will be equal to the purchase price, or the purchase cost, which is equal to annual demand, which remains the same, times the purchase price per unit, which is this one, 38, plus the holding cost, which is equal to Q. Our Q here is 180, divided by 2, times the holding cost, which is 570, plus the ordering cost, which is basically equal to the annual demand for 80, divided by Q. Our Q is 180, times ordering cost per order, which remain the same, the same. So let's get the total cost associated with that order size. So the purchase price or the purchase cost will be for 80 times 3,800. That will be 1824. Then we have 180 divided by 2 times 570, which is basically 51,300. And then we have 480 divided by 180 times 6250. 6250. Yes, what are you getting? What are you getting? You're getting what? Yes, 91, 967. 967, is that what you're getting? Is that what you're getting? 1891, yes. So basically, in our case, we have computed the costs, which are basically associated with what? Associated with those particular different order size. Now, if you check on what the examiner was asking, the examiner was asking about the cost minimizing order size. The cost minimizing order size. Remember, in our case, we have 3 order size. The company can either order 100 mattresses, 120 mattresses, or 180. Which order size will result to the least cost? So the one which will result to the least cost is the third option here. Is the third what? Options here. Is the third what? Option, the third option. And therefore, in this case, we will say what? We will say the cost minimizing order size. Order size is 180 mattresses. 180 mattresses. 180 what? Mattresses. 180 mattresses. 180 mattresses. So in this case, you may also be required to, for example, give an advice to this company. But this was not a requirement of the question. We were just required to ascertain the cost minimizing order size. We have been able to do that, and basically have said that the cost minimizing order size is what? 120. But in this case, you may be required to give an advice to the management of this company. In this case, if you are to advise them, we will advise them to go or to accept a 5% discount. Remember, if the company accepts a 5% discount, or basically we can order them to order 180 units and get a 5% what? Discount, because that is basically resulting to the what? Cost. So we can say our advice is that to this company is to purchase 180 mattresses, and basically do what? And qualify and qualify for what? Qualify for 5% discount. Qualify for 5% what? Discount. Qualify for 5% what? Qualify for 5% discount. Yes, so that is, you're required to advise this company on what? You're required to advise this company on maybe what to do. Which discount do they need to accept? Which discount do they need to accept? Yes. We are basically done with that one. I want us to look on another one. So these questions are very, very common. You'll be able to see that. You'll be able to see that these are very, very common. Very, very common. Let's look on this other one for September 2021. September 2021. September 2021. 2021, we have question number 3. Question 3. Question number 3B. 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 So let's go to that question. Question number 3. Question number 3. Question 3B of September 2021. September 2021. If you're there, please confirm. Yes, are you there? Are you there? Are you there? If you're there, please confirm. Please confirm if you have the question with you. September 2021. September 2021. September 2021 question. Question 3B. Okay, so we are told Fanaka Enterprises uses economic order quantity to establish the reorder quantity of raw materials, raw material Y. The company hold no buffer stock. So in this case, when we talk about buffer stock, this is the safety stock. The safety stock. Safety stock. So we are told the following information related to the raw material Y. We are given the annual usage. Annual usage, remember, we said is also the same with annual consumption. This is actually the same with the annual demand. So basically 48,000 units. The purchase price, which is 80 shillings per unit. The ordering cost, 120 per order. And then the annual holding cost is 10% of the purchase price. You can see the holding cost always is given as a percentage of the purchase price. Of the purchase what? Purchase price. Abdinasil, I've just shared those past papers in the class WhatsApp group. Can you check? I've just shared those papers in the class WhatsApp group. Although maybe someone can take a photo of the question and maybe post it in the group to assist our friend here, Abdinasil. Okay, so we are told the company, in the last paragraph, the company as a supplier of raw material Y has offered a discount of 1% of the purchase price if each order placed is for 2,000 units. For 2,000 units. So what are we required to do? One is we compute E or Q of material Y. Roman 2, we advise the management of this company on whether to accept or decline the discount. To accept or decline what? The discount. We start with Roman 1. Roman 1 is quite simple. That's why you can see only 2 marks are given. 1 mark is given, E or Q, for raw material. For raw material Y. Raw material Y. So this one is equal to the square root of 2D C0 all over HC. And I think in our case, we have these particular values. We have all of them. We take 2. We have the annual demand, or basically the annual usage, which is 48,000 units. That is the annual demand, 48,000 units. Then we multiply that with the ordering cost per order, which is 120. And then we divide that with what? The holding cost. The holding cost in our case, is what? Is 10%. Now, Italy, you have already computed this. You are very fast. Yes. So this is basically 10% of the purchase price. The purchase price is basically 80. is what? Is 80. So this one will be 10% of the purchase price. Our friend here, Naitari, has already computed that. Naitari, you are very fast. So maybe just confirm this. Just confirm whether you're going to get those 1,200 units. 1,200 units. 1,200 units. Is that what you're getting? 1,200 units, 2 times 48,000 times 120 divided by 8. Square root answer. Yes, so that basically will give us what? That will give us 1,200 units. 1,200 units. So this is the economic order quantity. Just one mark which was allocated for that. So then we go to Roman 2. Roman 2, we are required, what are we told here? We are told to advise the management of this company whether to accept or decline the discount. So we are required to do what? To advise on whether to accept or do what? Decline the discount. Decline what? The discount. Decline the discount. Should the company accept this discount or not? Remember what you're told in the last paragraph. We are told the company supplier of raw material Y has offered a 1% discount if each order placed is for 2,000. Remember, we are saying here, as per what we have computed here, for the company to be able to minimize the cost associated with the raw materials, the company has to be ordering 1,200 units. So this is the order size, which will basically minimize what? Minimize the raw materials costs. But we are told here, the company has been given another option. Instead of ordering 1,200 units, why not order what? Why not order 2,000 units and then you qualify for 1% discount? So basically here, just like what you have done in the other question, the company has 2 options. There are 2 options available to this company. The first option basically is to order 120, or not 120, rather 1,200 units. So if the company order this, the company will pay how much per unit? As per the information we have below paragraph 2, the company will pay 80 shillings per unit. That is the normal purchase price. If the company purchases 1,200 units, and also remember this is the purchase price, which is basically P. So what will change here also is this one. The holding cost per unit will be equal to 10% of this 80. The holding cost will be what? Will be 8 shillings per unit. So if the company order 1,200 units, it will pay 80 shillings per unit. The holding cost will be 8 bob. But now the company has been given option 2. Option 2. Instead of ordering this, the company has been given an option to order 2,000 units, and the company qualify for 1% discount. So if the company qualify for 1% discount, the company automatically will not pay 80 shillings per unit purchase, but the company will pay 99%, because it is 1% discount, 99% of the purchase price, which is basically 80. So this will give us what? If the company accepts the discount. If the company accepts the discount, the company here will pay 79.2. 79.2, 99% of that. So I hope you're getting that. Yes, that also means that the purchase, not the purchase, the holding cost per unit will be 10% of this, 79.2. And basically that will give us 7.9 what? 0.92. 0.9 what? 2. Now, what basically we need to do, just like the other question, we need to evaluate those 2 options. How do we evaluate those 2 options? We need to compute the total cost of each option. Then we are going to, if for example, this now option 2 will basically will result to a lower cost than option 1, automatically we're going to advise the management to accept the discount. But if option 2 will have a higher cost than option 1, we are going to advise them not to accept the discount. So let's evaluate these 2 options. We start with the option 1, where our Q is 1,200 units. 1,200 units. And remember, we evaluate this option in terms of computing what? In terms of computing the total cost. So what will be the total cost? Maybe you can first of all have the formula, the purchase cost, which is equal to P times D plus the holding cost, which is equal to what? To Q divided by 2 times what? Times HC plus the ordering cost. The ordering cost, which is basically equal to annual demand divided by Q times what? Times C naught. Times C what? Naught. So let's start by computing the cost of the first option. The first option, where basically our Q is 1200. So the purchase cost will be equal to the purchase price here, which is 80 shillings, times the annual demand. The annual demand, I hope you can be able to recall that in our question. The annual demand is 48,000 units, plus the holding cost, which is equal to Q. Our Q is here is 1200 divided by 2 times HC. HC is 8 shillings here, plus the ordering cost, which is equal to annual demand, 48,000 divided by Q, which is 1200 times what? Times ordering cost. The ordering cost in our case is how much? The ordering cost is 120. 120. So we get the total cost of that. Let's get the total cost associated with that order size. The total cost associated with that order size. What will be the total cost associated with that order size? What are you getting here? I'm getting what? 3849. I'm getting a different figure. Naitali, is that correct? I'm getting this one. 3849. 600. 600. That is what, yes, that is also the same figure I'm given by this there. Yes, Naitali, confirm your answer. I don't think it is correct. I don't think it is correct. And also, I hope you can see that because these are economic order quantity, you can see that these two costs are the same. That's what you have said. At E or Q, always those two costs must be the same. So then I want us to evaluate the second option, where our Q is basically 2,000 units. 2,000 units. So what would be the total cost associated with this? So we start with the purchase cost, which is equal to the purchase price. The purchase price per unit is 79.2 times the annual demand or the annual usage, which is 4,800, plus the holding cost Q, which is basically 2,000 divided by 2 times HC. HC here is 7.92, and then plus the ordering cost. Ordering cost is equal to annual demand, 48,000 divided by Q, which is basically 2,000. 2,000 times what? Times 120. Times 120. Times 120. Times 120. Yes, so let's work out this. Yes, what are you getting? I'm getting 3812 400. 3812 400. 3812 400. Yes, 3812 400. 3812 400. 3812 400. 3812 400. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes. Yes. Now, in this case, what we need to do is basically we now move and basically we advise the management of this company, should they accept the discount or not? Should the company accept the discount? Remember, if the company is to accept the discount, the company will have to order 2,000 units. So what you need to do, you need to compare the cost of the two order size. Remember, the order size here is 1,200 units. The order size here is 2,000 units. So should the company accept the discount or not? Should the company accept the discount or not? Should the discount be accepted or not? Yes, automatically the discount should be accepted, because you can see that there will be some cost savings. There will be some cost what? Savings. Or in other terms, we can say that the company will incur the least what? Cost. So we say, we give the advice. Advice will be accept the discount. Accept the discount. The discount, since it results to cost what? To cost savings. To cost savings. Remember, currently, the company is ordering 1,200 units. So how much cost is incurred by the company currently? The company is incurring this cost. This is the cost incurred by the company currently. But if the company accepts the discount, we say there will be some cost savings. The cost savings is the difference between those two costs. The cost savings is the difference between those two what? Costs. Can you tell me how much is the difference between the two costs? Between the difference between the cost of the two options. The difference is 37,200. So since it will result to cost savings of shillings what? 37,200. Basically, which you're saying is the difference between 49,600 and 38,12 forward 400. So that will result to some cost savings. It will result to some cost what? To some cost savings. It will result to some cost what? Savings. Sawa? Yes. So maybe what I want us to do, we take a short break. And then once we come back, I want us to look on something called the multiple quantity discount. The multiple quantity discount, because basically what you have dealt with here, this one is basically called a single quantity discount. A single quantity discount. So if the company purchases, for example, 2,000 units, the company qualify for what? Like 1% discount. That is a single quantity discount. But we have another option whereby the company will be given a multiple quantity discount. I'll be able to explain what you mean by multiple quantity discount. How do we evaluate now such option, and basically how do we advise the company? Sasa? Yes, but I want us to have that discussion once we come back after a short break of just 10 minutes. So after 10 minutes, we come back, we continue with that. Yes, so I want us to continue. I hope you're back. Are you back? Are you back? Are you back? Aaron, are you back? Zipporah, are you back? Naitari, are you back? Emma, are you back? If you're back, please confirm. Please confirm. Please confirm. I want us to look on this. That is basically the multiple quantity discount. Multiple quantity discount. Now, when we talk about the multiple quantity discount, this whereby discounts will basically be given for different quantity rates. For different quantity rates. And actually, the main objective of this multiple quantity discount is usually to encourage buyers to buy more quantity at lower prices. More quantity at lower prices. The more the quantity you purchase, the higher the discount you get. The higher the discount you get. And therefore, when we talk about a multiple quantity discount, this whereby, for example, you have a supplier, assuming you have a company and you buy some raw materials from your supplier, and you're told, if you buy between, for example, maybe 0 units, or basically 1 unit, that is 1 unit, maybe to like 99 units, maybe in this case, there will be no discount here. Or maybe the discount here will be 0%, no discount. But if you buy now from 100, for example, to 199 units, you will qualify for something like 2% discount. If you buy between 200 to 2, or maybe to something like 499, maybe you will qualify for 3% what? Discount. If you buy between 500 and above, maybe you qualify for what? For 5% discount. Now, this one is called a multiple quantity discount. You can see the main objective of this discount is basically to encourage buyers to buy more quantity. The higher the quantity you purchase, the higher what? And the discount. The higher what? The discount. Now, in this case, automatically what we need to do here is to advise the company the quantity rate to pick. Should the company order this the quantity rate? Should the company order units which lies within this quantity range? Should the company order units which lies between this quantity range and so on? So that basically is the main objective here, to evaluate basically each quantity range and basically go ahead and you give an advice to the company. Should the company or which order range should be picked by our company? Automatically, the order range to be picked by our company is the one which results to the least what cost. And actually, we also evaluate this particular order or this quantity range by computing the cost of each quantity range. And therefore, in case you come across such a question whereby we have multiple quantity discount, the first thing you need to do is to purchase, that is to compute, that is, you need to compute the purchase price per unit. Remember, the purchase price per unit is basically P. Because, for example, here you can be told between 100 and maybe 99, the price is maybe 10 shillings. So what will be the price here? The price here automatically, because the company will get a 2% discount, the price here will be 98% of over 10 shillings.
Starter class is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money, it is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million because this, it may be, if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount was be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth. What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting is determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you are supposed to compare the two, you cannot compare when they are not in the same form. You are supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number 1. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So, just write concepts of compounding, or compounding techniques, and we start with the first one: future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So, we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal. 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. you cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000s that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear, a lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus R power n. Principal times 1 plus R power n. And this is what we call present value. Present value. This principal figure here is what we call present value. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of an annual, future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus R power n. This factor here, this factor 1 plus R power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus R into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Eh? Yeah. Do you have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value we are saying is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000. That is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. At least repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount. Amount with, let's say, 100,000. No, will that give us? No. No, that is the only way. Okay. The other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus R power n minus 1 over R. That's how we get the future value of an annuity. 1 plus R, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus R into brackets power n minus 1 over R. This factor here, the factor 1 plus R power n minus 1 over R is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate, and it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says no. No, we have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shilling 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus R power n minus 1 over R. So here you say 60,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer. Get the answer. Three 322,080. Another person. 322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period, 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 60. 60. 60. 60. At the end of each period, this person is investing 60. So here you say 1 plus R power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus R. 1 plus R. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept, the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call okay, fine, Alice, 080. Okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year. At the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that we invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. One plus r power n minus 1 over r times 1 plus r. So this is now what caters for the element of investing at the beginning of the period. So you can write that. And then we have an illustration. So back to the handout, there is an illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they are saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000? So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity. And you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus R power n minus 1 over R times 1 plus R. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see So how much are you getting? 711,518.9. 711,518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, the reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Eh? Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year 1. So we are saying this first 100,000 that was invested at the beginning of year 1, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we are saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you're getting here. So just check whether you're getting the same. One 76 to 34 point you can, okay, in this case you can round off. In this case you can round off to whole numbers. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34, 157, 352, 157, 352, 144, 93, 144, 93, 125 for 40, 125 for 40, and 112,000. So get the sum. $711, $519. $711, $519. Now, the reason why we are doing these two methods, this is very short. This is like a shortcut. But we are doing this method so that you can get the concept. Because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period. This and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. Discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting it is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting. Or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum still the same thing as we've said. An amount that is paid or received once is what we call a lump sum. So how do we get the present value of a lump sum? Present value just say PV, present value of a lump sum is equals to future value times 1 plus R power negative n. 1 plus R power negative n. So look at this factor now. Look at this factor now. Under compounding, we were saying power n, positive n, because we were moving forward. But now, under discounting, we are saying negative, because we are moving backwards. So get the difference. Present value for lump sum is equals to future value times 1 plus R power negative n. So where this is future value, R we said is the required rate of return. N is the number of periods, as usual, number of periods. Now this factor, the factor 1 plus R power negative n, the factor 1 plus R power negative n, we call it present value interest factor. This one, we call it present value interest factor. Present value interest factor. In this one, we can read from the tables. So present value interest factor, which is indicated as this present value interest factor, R percent power n. Present value interest factor, R% power n. So let me share with you the present value interest factor tables. The present value interest factor tables. Just check on your WhatsApp. Check on WhatsApp. Check in the WhatsApp group, I mean. I'm sharing the present value interest factors table, present value interest factor tables that we use for discounting. Present value interest factor tables that we use for discounting. I have shared. Once you receive it, kindly let me know. Once you receive it, kindly let me know. I want to show you how we read. Okay, but that one you're going to do in an illustration. We're going to do in an illustration. So what do you need to add here? Nothing. Nothing. So when we are using tables, we say present value of a lump sum with tables. We say present value of a lump sum is equals to future value times present value interest factor R% power n. So this factor here, this is R, this is R, this is R% power n. Present value for lump sum is equals to future value times present value interest factor R% power. Because this factor should give us same figure as we have here. So let's have an example. I want to believe we have an example there. Let's go to discounting. Skip issues to do with quarterly discounting and semi-annually discounting. Let us go to discounting techniques. Discounting techniques, and we have an example there. We have an example there. Example says, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent? So we are saying, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent using present value? Okay, ignore that. Just ignore that. So here we have been given the future value. We've been given the future value. So here we're saying future value, it is the amount that you will receive in future. 172,800. Assume you are to receive 172,800 3 years from now, and 3 years. And the rate of interest is 20%. 20% per annum. So here we will say present value is equals to future value 1 plus R power negative n. Power negative n. So present value is equals to 172,800 times 1 plus 0.2 power negative 3 power negative 3. In short, how much are you supposed to invest today to earn to get 172,800 after 3 years at an interest rate of 20% per annum? Again, you say 100,000. 100,000, okay. 100,000. And or present value is equals to future value times present value interest factor R% power n. So this one you write 172,800 times present value interest factor 20% power 5. 20% power 5. So 172,800. So this factor now, we are going to read it from the tables. We are going to read that factor from the table that I've just shared. From the table that I've just shared, let's go there. From the table. Are you there? Kindly confirm. Confirm we're together. Oh, it's power 3, sorry. Power 3, power 3. Power 3. Thank you for your correction. I want to believe you have the table that I've shared. Now, in that table, in that paper, there are two tables. We have upper one and the lower one. And you can see some formulas written above there. So you can see the first one, they have written present value interest factor, present value of received at the end of periods, end periods. And we have the other one down there, present value of an annuity of 1 per period for n periods. So the upper table is for lump sums. The upper table is for lump sums. The lower table is for annuities. The lower table is for annuities. Now we are talking about lump sums. We are looking at the present value for lump sum. So you will go to, if you look at the upper row, in table 1, the upper row, we have percentages. The upper row, the first row, if I can say, we have percentages. And in the first column, we have periods. We have periods. So like, for example, we have periods upper. We have 1, 2, 3, 4. Then we have these percentages, 1%, 2%, 3%, all the way to 20%. We want 20%. So now, in our case, we are interested in 20% at period 3. 20% at period 3. So you go to period 3 and move up to 20%. You read the factor that is there. Just like we were doing in multiplication tables. Just like we were doing in multiplication tables, that is what you are doing. You go to the period, then go to the percentage. Or you go to the percentage, you drop up to the period that is required in the question. So read the factor that is there. At 20%, period 3. 20% at period 3, you're getting. Write the factor there, 0.5787. 5787. 0.5787. 0.5787. Then you multiply now. 0.5787. 5787. So then you multiply by this factor, but not factor, but amount. How much are you getting? 99.99.36. That is just like 100,000. You can see these factors are rounded off to 4 decimal places. So, but that is what you're supposed to do. That is what we are supposed to do. Any question? Any question? Okay, fine. If no question, we proceed. Present value No, yeah, present value of an annuity. Present value of an annuity. Present value of an annuity. We have seen what an annuity is. Present value of an annuity. Present value of an annuity. And the present value of an annuity, we say present value of annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. So have that. Present value of an annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. Then we are saying this factor, the factor 1 plus 1 minus 1 minus 1 plus r power negative n over r is called present value interest factor of an annuity r percent power n. Present value interest factor of an annuity r percent power n. Thus present value of an annuity is equals to the annuity times present value interest factor annuity r percent power n. R percent power n. I can't find 0.5787. Catherine, let's go back to that table. Let's go back to that table. The upper table, 5787. We are using the upper table, Catherine. Are you there? Kindly confirm you're there, Catherine. Go to 20% under column, under row 1, the top row, go to 20%. After reaching 20%, go down to row 3. Not 3, but count 1, 2, 3. At 20%, you should go up to 0.5787. You'll see, yeah, that's how we read this thing. So for the annuities, this is how we, and you should be able to compute this. You should be able to use this. Remember, this formula here, this formula that you're seeing here, this one, it gives us the same figure as what we have in the tables, rounded off to 4 decimal places. You round this to 4 decimal places, you're supposed to be getting the same figure. So nothing different. So let's see an illustration. An illustration present value of an annuity. Yeah, we have an illustration and a present value of an annuity. An illustration and a present value of an annuity. And they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. What is the maximum amount would you be willing to pay For that project, if the required rate of return is 10%. So let's do that. Now, when you are ever told to determine the maximum price to pay, and I saw that kind of a question in the last sitting paper. Every time you are ever told to determine the maximum price to pay, the maximum price to pay for an asset or for anything must be equal to the present value of the expected benefits. Must be equal to the present value of the expected benefits. Maybe we can have a look at, do you have your past papers? Let's look at the past papers. Just open your past papers. I show you that